Welcome back to The Explainer. Today, we're unpacking a wild corporate ride. We're looking at Vikram Solar Limited, one of India's biggest pure-play solar module manufacturers. If you follow renewable energy, you know they've been making major headlines lately. But behind the dry financial reports and credit ratings, there's this absolutely fascinating story of resilience, boardroom shuffling, and a literal multi-billion rupee bet on India's energy future. Let's dive in. To really understand Vikram Solar's trajectory, we're going to break this down into 4 key areas. First, the insolvency near miss. Second, a record-breaking financial year. Third, a strategic leadership shakeup. And finally, their massive push to scale up to gigawatt capacities.
Part 1. The insolvency near miss.
So picture this, it's June 2026 and an unexpected crisis hits the financial markets. For a company supposed to be leading India's renewable transition, getting dragged into a corporate insolvency resolution process is, well, basically an investor's worst nightmare. And the craziest part, it was over a surprisingly tiny vendor dispute. Here's what happened. Vikram Solar won a contract from the Andhra Pradesh Power Generation Corporation and subcontracted a piece of it to Isitva Steels. The job gets done, but a dispute pops up and a small portion of a settlement payment gets delayed. Because that delayed amount crossed a specific statutory threshold, Isitva filed a legal claim for 94.4 million rupees. The National Company Law Tribunal, the NCLT, actually admitted the petition. Just like that, boom, a corporate giant gets slapped with a moratorium. What followed was a total legal roller coaster packed into just 2 weeks. The NCLT admitted the petition on June 12th, and by the 18th, the order was public. But Vikram Solar? They moved incredibly fast. They immediately escalated things to the Appellate tribunal. By June 24th, they just agreed to hand over a demand draft for the pending dues, and the subcontractor backed off. By June 29th, the whole proceeding was totally set aside. Crisis averted. And this right here perfectly illustrates why India Ratings officially called the whole event credit neutral. I mean, look at this scale. A 9.2 million rupee dispute is practically microscopic when you realize they had 7.3 billion rupees in consolidated free cash sitting there after a highly successful IPO. Their underlying fundamentals were literally never in jeopardy. It was just a procedural friction point. It's a classic reminder of why you have to dig into the primary source data. The headlines were screaming insolvency, but the balance sheet was quietly whispering absolute stability.
Part 2. A record-breaking financial year. So, with the legal drama out of the way, taking a look at their balance sheet completely explains why they have an A+ credit rating. The financial year ending in March 2026 was just transformative. The huge takeaway is their explosive growth. Net profits rocketed up an unbelievable 239% year over year. Sales jumped from 3,423 crore to 4,802 crore. That's a 40% leap in a single year. But the real story? Profitability. Operating margins improved from 14% to 19%, pushing net profits from 140 crore to an astonishing 470 crore. This tells us they aren't just selling more modules. They're making and selling them with way better cost efficiency and serious pricing power.
If we zoom in on just the fourth quarter, we see a company operating at massive scale. They pulled in 1.9 gigawatts of new orders just by staying hyper-competitive on price. In 3 months alone, they brought in 1,453 crore in revenue and produced nearly a full gigawatt of solar modules. According to their investor presentation, they pulled this off through super stable assembly lines and rapid team execution, hitting a really impressive 75% effective utilization rate for the year. And we're not talking about basic tech here. They're churning out highly advanced modules like P-type monocrystalline and N-type heterojunction systems. Basically, top-tier tech designed to capture way more sunlight. And clearly, the market is eating it up. Now, check out this 30.5% return on capital employed. This metric is the real proof that Vikram Solar isn't just inflating their revenue numbers. They're deploying their cash with ruthless efficiency. A 30.5% ROCE? That's a fantastic signal of a management team that knows exactly how to squeeze value out of every asset. Combine that with a 21.5% return on equity and an 85% ratio of free cash flow to operating profit, and you've got a remarkably healthy manufacturing machine generating massive internal cash to fund whatever it wants to do next.
Part 3. Strategic leadership shakeup.
Scaling from millions in revenue to billions requires a completely different operational playbook. To manage this hypergrowth, the company basically had to rewire its boardroom. This realignment brings in fresh executive blood while keeping that crucial legacy expertise. Ganesh Chaudhary was reappointed as chairman and managing director, which guarantees continuity. But the real shakeups are bringing in Samir Nagpal as the new CEO and whole-time director and strategically shifting Neha Agarwal's role. The expanding operational demands completely drove Ms. Agrawal's pivot. If you read her actual resignation letter to the board of directors, she spells it out perfectly. She says her executive responsibilities had expanded so much that she just couldn't juggle the time needed for both ground-level strategy and board service. So, she officially stepped down from the board to take on the role of Senior Vice President of Corporate Strategy, becoming laser-focused on international business and their annual operating plans. And that move perfectly cleared the runway for the new CEO, Samir Nagpal. The board was very specific about why they hired him, highlighting his 30 years of rich experience spanning transformation, growth acceleration, and value creation. With Ms. Agarwal shifting to high-level strategy, Nagpal steps in to run the day-to-day machine. He actually has a background in mechanical engineering, which is honestly exactly the kind of gritty operational rigor Vikram Solar needs right now as they transform from a big domestic player into a global heady here. Part 4. Scaling to gigawatt capacities. Well, that new leadership team is going to be put to the test immediately because they're rolling out one of the most ambitious expansion roadmaps we've ever seen in the Indian renewable sector. Right now, Vikram Solar is operating at a 4.5 gigawatt installed capacity across its current facilities. But they are looking way, way past that. They just approved a jaw-dropping capital expenditure of 3,726 crore rupees to build a backward integrated wafer and ingot facility in Tamil Nadu. To put that into perspective, this single investment is a massive chunk of their total capital. And it's not just about doing more of the same. This is about fundamentally changing what they build and what they control in the solar supply chain. Here is the exact step-by-step game plan to take them from just a component provider to a fully integrated solar titan. They're taking their already robust module line and moving backward up the supply chain. By financial year 2029, they want that 6-gigawatt wafer and ingot facility fully up and running. By FY30, they're planning to commission a 12-gigawatt cell line and push their module capacity to a massive 15.5 gigawatts. We're talking true vertical integration here, owning everything from the raw silicon wafer all the way to the finished module on your roof. And the timing of this multi-billion rupee bet? Absolutely not an accident. It is perfectly timed to catch a massive regulatory wave. Enter ALMM3, the approved list of models and manufacturers. It's a critical policy framework from the Indian government. There's an upcoming mandate in June 2028 that will heavily favor, and in many cases strictly require, the use of domestically manufactured solar components in government and major private projects. So Vikram Solar aiming to get these new capacities online by FY29, that is surgically synchronized to capture this incoming flood of domestic demand the exact second the mandate kicks in. Ultimately, this entire infrastructure pivot is about indigenizing the supply chain. It's about making sure India isn't reliant on imported solar parts anymore. By anchoring this massive project down in Tamil Nadu, they're plugging right into an incredible industrial ecosystem. Look, the company already serves heavy hitters, NTPC, Adani Green Energy, massive international developers. To keep serving those clients securely, they have to insulate themselves from global supply chain shocks. This expansion is them directly stepping up to India's national imperative to become completely self-reliant in renewable energy manufacturing. So I want to leave you with this thought to chew on. How much of our national energy future now rests on companies actually pulling off ambitious blueprints, exactly like this one? We've just seen how Vikram Solar swatted away a legal insolvency scare, delivered sky-high profits, re-engineered its leadership, and committed literally billions to domestic manufacturing. Whether they succeed in pulling off this complex, backward integrated expansion, well, it won't just decide their stock price. It could very well be the bellwether for India's entire renewable energy transition. Thanks for diving into the data with me today. Keep asking questions, keep checking those primary sources, and I'll catch you on the next explainer.